So welcome to today's webinar, Credit and Debit Decoded, Empowering Financial Decision Making with Debra Jacobs. This is the second of a three-part financial webinar series. I'm Cynthia Cross, I'm HFA Services Manager, and I'll do a quick introduction of HFA, the program that this webinar is coming from, and our incredible speaker. So HFA is a national nonprofit organization that was founded in 1994. We assist, educate, and advocate for the bleeding disorders community. The presentation today is provided through HFA's Helping Forward program, where we work to assist families transitioning from financial crisis to financial stability. The Helping Forward program also provides a job readiness grant, which provides up to $1,000 towards a course, training program, or certification that can help adults with bleeding disorders or carriers gain a promotion, sustainable employment, or help those looking to make extra income on the side. College courses are considered for this grant, and applications are open and processed as soon as they are received. We have our final webinar of this financial series coming up, and it focuses on budgeting, and that will be held on November 2nd at 8 p.m. Eastern Time. If you're interested, please register on our website, and we'll also share the link in the chat too. Now to introduce our speaker, we have Debra Jacobs. She's the founder of Money Smart for Life, a financial coaching business that helps people overcome shame, fear, and overwhelm around money and take action to master their personal finances. She has developed financial literacy curricula, taught classes to teens and adults, presented financial wellness workshops around the country, and worked with many clients to achieve positive, measurable results. Those results include, among others, moving beyond limiting money mindsets, becoming intentional with values-based budgeting, making and carrying out savings and debt paydown plans, and achieving financial goals. Debra is also a published author and editor and holds an Ed.M. From Harvard University's Graduate School of Education. So I will go ahead and stop sharing so that Deb can go ahead and take it from here.
All right. Hello, everybody. It's so nice to be back. I am going to share my screen with, here we go. So we're going to be talking about credit and debt tonight, and we have a lot to cover. I want to just introduce myself. Thank you so much for that wonderful introduction, Cynthia. But I'd like to tell you a little bit about my backstory if you missed last workshop that we did last time. So I'm a financial coach, sometimes called a money coach, and I'm a single mom. And for many years while my kids were growing up, I ran a preschool, which was great because my kids could be with me after school, and it provided a nice life for us. But while my kids were little and while I was running my preschool, I gave myself excuses about my own personal finances. I was afraid of money. I didn't know much about it. I didn't save much. I didn't invest much. And I was kind of a mess. And when my kids got a little older, a little space opened up in my life, and it was really time. So jumped in, learned everything I could, got my AFC, which is Accredited Financial Counselor certification, and started my journey, my own personal journey towards financial wellness. And I was so surprised that I loved it so much. I really found personal finance fascinating and decided that this is what I want to do. So I ended up closing my preschool and opening this business, and that is what I've been doing full force ever since. So we're going to start today by playing 3 really simple games. And Cynthia, maybe you can help me with the chat if anybody wants to jump in. So the first game that we're going to play is called You Are a Banker. And if you're a banker and somebody comes to you for a loan, what are the kinds of things that you want to know about that person before you loan them money? So does anybody have any ideas about what you might want to know about a person before you loan them money? All right, I'll get started with a few. If you have any other ideas, just go ahead and jump right in. So one thing that you would want to know is is this person trustworthy? Will they pay the money back? And how would you find that out? You want to know what their history is. Have they paid money back before? Do they have good financial management habits? They don't overspend, they pay their bills on time. And you might want to know, are they new to those habits, or if they had those habits for a long time? Are they struggling financially, or are they in good shape? How much debt is this person in already? And do they make enough to cover this new loan that they want? If they already have a lot of debt, they might not have enough money left over to pay that debt and to pay the new debt. How long have they been employed? What's their salary? And do they have any assets that maybe I could take if they can't pay back the loan? So if you're a banker, those are the kinds of things you want to know. If you have any other ideas, go ahead and put them in the chat. And Cynthia.
Yeah, a couple, Deborah.
Okay.
How much do they want?
Yes, absolutely.
How will they pay it back? And
yep.
Checking credit.
Okay, well, that's what we're going to talk about. But let's go to our second game, which is we're going to play now. You're a landlord. So let's say you have a unit to rent and two people come to you and they fill out applications and they both want to be your tenant. How do you choose? What are the kinds of questions? What kinds of things do you want to know about these tenants? Okay, so ideas in the chat?
Yep, one just came up. How much do you make?
Absolutely. Absolutely. You would want to know, are they employed and what's their salary for sure? Other ideas about what you would want to know if you're renting a unit?
How long have they been employed?
That's another really good one. How long have they been employed? Yep. Some other, I see a couple.
Yeah, they're coming in. Rental history and if they have pets.
Oh, pets. I hadn't thought about that one, but that's a really good one. You would definitely want to know that. And for sure, you would want to know their rental history. Have they paid their rent on time? So I would want to know, like, have they ever been convicted of a crime? Maybe I would want to know, if I rent a unit, particularly if I own a 2-family home. So I want to make sure this person coming into my home really has good character. Will they pay their rent? Do they have a history of paying their bills on time? And I also want to know, do they have good references from previous landlord? Is this the kind of person who's going to play music really loud until midnight? Do they keep clean, or do they throw trash around? I want to make sure that this person's going to take good care of my property. Anything else before we move on to the next one?
And we just had one more come in, and that was checking credit again. So doing it as a banker and as a landlord.
Yes, exactly. I think you're catching on here. All right. So one more. Now you're an employer and you're considering hiring somebody to work in a sensitive role that involves the company's money. So what do you want to know about this person? Ideas about what you would want to know before you sign this person's contract?
And we've received credentials as one.
Yep. How many credentials do they have? Are they qualified for the job for sure? Anything else?
If they have criminal history.
Yep. You would want to know that if they're working with money. All right. So skills, credentials, education, training, you definitely want to know that. What kind of experience do they have? And if they're dealing with the company's money, have they proven to be trustworthy? And I would want to know, do they manage their own money well? Because if somebody can't manage their own money well, I don't know that I would trust them to manage the company's money. So obviously, all three of these have to do with credit. And a credit report or a credit score will help the banker, the landlord, the employer to gain some of that information, but not all of it. So let's look at what information does a credit report give you, and what information does it not give you? So a credit report includes personal identifying information, so names, birthday, social security number, addresses, things like that. Your employer may or may not show up, but it's definitely doesn't always show up. So it definitely will include any loans, credit cards, student loans, auto loans, home equity lines of credit, mortgages, really any debt that you've taken out. That's the main thing that the credit report is going to show. It will also show if you've had a bankruptcy. So there are two kinds of bankruptcy, Chapter 7 and Chapter 13. Chapter 7 bankruptcy will stay on your credit report for 10 years, and Chapter 13 will stay on your credit report for 7 years. And if you've ever been late on paying your bills, and a collection agency has tried to get that payment for you, the collection agency will likely report you to the credit bureaus. And so collections will show if any bills have been in collections, that will show up on your credit report for 7 years. Also, it will show any inquiries, like have companies asked to view your credit report? So this means if you're applying for credit cards all over the place, if you have 10 inquiries from credit card companies, a banker may look at that a little funny and say, why does this person need 10 credit cards opened all at once? That may be an indication that they're not paying all, they don't have the money to pay all their bills. They need to open credit cards to carry them over. So what does a credit report not include? So it doesn't include any financial information that is not related to debt. So it won't have your bank account information, it won't have your investments, it won't have assets, only debt-related financial information. It won't have your income. So all those things that the employer wanted to know and the landlord wanted to know, they have to find that in another way. They might give you an application and ask you to fill it out with all that information, but they're not going to get it from the credit report. It won't have your employment status. Your credit report will not say if you're employed or not. And it won't have public records other than bankruptcies. So it won't show, like if somebody put a lien on your house or traffic tickets or other things like that, that's not going to show up. And it also doesn't include personal information that doesn't have to do with debt. So are you married, race, religion, disability, medical information? None of that is going to show up on your credit report. So let's talk about the difference between a credit report and a credit score. So there are 3 companies, Experian, Equifax, and for some reason I'm having a brain freeze about the third one, that are the 3 main credit reporting agencies in the United States. They're the ones that pull in all this information about your debts to create credit reports. Then let's say you go to the bank for a car loan. The bank is going to pull those reports and put them through some formulas and get something called a credit score. A credit score is not fixed. It's not, if you apply for different kinds of loans, they might have a different formula that they plug in to get a different score. They'll probably be all pretty close. The main one is called FICO. It stands for Fair Isaac Corporation, and they're just the company that spits out credit scores that most banks, I think like 90% of banks use. So what's a good credit score? So there's your report. The loan officer gets your report and puts it through this algorithm that comes up with your score. And anything below 579 is you really need to work on. And then it goes up, 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 all the way to 850. So if you're in the 800s, you're doing fabulous. That's great. If you're in the 740 to 799, you're doing pretty well. And then it goes down from there. Why is this important? Why bother building good credit? As we talked about, it can help you rent an apartment. It can help you get a mortgage, can help you get a job. Without good credit, you may not be able to get a car loan, or they're going to charge you higher interest. The lower your credit score, the higher interest a lot of loan officers are going to charge you. You may not be able to get insurance with a really low credit score. And again, favorable terms on loans and credit. So credit is actually really important. And you really want to start, if you haven't yet, you want to start building up your credit. So let's talk about, what if I don't have a credit history? What if I'm 18 and I'm just starting out in life? Or what if I have maybe been a stay-at-home mom and my partner has been the person who's handled all the money and has the credit cards and everything in his or her name, and I don't have my own credit history? How do I get a credit history? And the way you get a credit history is by taking out a loan. And that loan, the easiest way to do it is to get a credit card. If you have a student loan and you're starting to pay it back, you're building a credit history. If you have a car loan, which you may not be able to get if you don't already have a credit history, but if you have a car loan and you're starting to pay that back, you're building up a credit history. So what do you do if you don't have one? You open a credit card and you use it wisely. And we're going to talk in a minute about ways to use credit cards wisely. If you're a student, there are credit card companies that offer student or recent grad credit cards. And the credit limit is low, but it's a way to just get established, start using it wisely, start paying it back on time, and starting to build up that credit. You can also become an authorized user on a family member's credit card, or if you're a parent and you want to help your teenager or your young adult child to get started, you can sign them on as an authorized user on your credit card. Now, thing to be careful about this is if your credit score is not good, don't give a card as a, don't have your child become an authorized user on your card, because their score will reflect your score. So if you have good credit, or if your parents have good credit, you're just starting out, that could be a really good idea. You don't even have to actually give your kid the physical card. You can keep the card. You can just sign them on as an authorized user so they can start building credit sort of off of your credit. But if you're worried about them going and using the card and racking up all kinds of debt, you don't even have to give them the card. Just have them be an authorized user and they'll start benefiting from your good credit. And then the other way to start building up a credit history is to get something called a secured credit card. It's a little bit like a debit card. You would go to one of these companies that offers a secured credit card and you make a deposit, whatever it is, $100, couple $100, $300, and that's the money that the credit card uses to secure whatever you spend. So you can't spend over what deposit you've made. After 6 months or a year of using this card, showing that you use it well, paying it back on time, they might take off the security and then you have a regular credit card. So that's another way to get started. Okay. So let's talk about the benefits of credit cards, and then we'll talk about the dangers of credit cards. So obviously, one of the benefits of credit cards is building and maintaining good credit. Anybody have ideas about other benefits of having a credit card? Go ahead and write it in the chat if you do. All right, I'll get started here with, oh, I see somebody is.
We have for emergencies and then ease of payment.
Absolutely. Anything else?
Not yet.
Okay. They're convenient. They're easy. They're super easy to use. You don't have to go to your ATM and pull out money. And almost most stores, most places take them. You can use them online. They're very convenient. You can get cash back or travel points. So if you use them wisely and you're interested in learning more about travel points, afterwards I can send to Cynthia a URL for a couple of free online classes that I am not in any way affiliated with. I just think they're great. And they will teach you about how to build up and use travel points if that's something that you're interested in pursuing. But credit cards can give you a few extra bucks if you use them correctly. Emergencies, somebody said, not most hotels and car rental companies will take debit cards, but not all do. Some require a credit card. Some cards provide travel insurance or collision insurance when you rent a car, so you don't have to pay that extra money. Just be 100% sure when you say no to that collision when you rent a car that your card actually covers it. So you do want to read the fine print. Credit cards have better fraud protection than debit cards. So if you are the kind of person who is not disciplined and you know that you're not going to use credit cards wisely, by all means use a debit card instead. But if you do use a debit card, sign up with your online services at your bank and check your account at least every couple of days. Because with a debit card, if somebody's hacked into your bank account or stolen your debit card, if you report it within the first 2 days, you're liable for only $50. If you report it within the first, don't quote me on this, but I believe it's 60 days, you're responsible for, I think, up to $500. And then after that, I mean, not all banks will charge you the whole thing, but after that, you could be liable for the whole amount of whatever they've fraudulently taken from your account. Whereas with credit cards, if you report fraud on your credit card, the credit card company will usually take care of it. You won't be liable for it. And the other way to look at it is if somebody steals your debit card and for some reason knows your password and all of that and takes money out of your bank account, that's your problem because you don't have money left in your bank account to pay your rent, to whatever, and then you have to fight, which is sometimes a month-long or more fight to get that money back. Whereas with a credit card, if somebody steals the credit card and somehow knows all your information and hacks into it, that's the credit cards company. It's not being taken out of your bank account. So credit cards do offer better fraud protection. But again, if you're not great with credit cards, if you're afraid of racking up a lot of debt with them, use a debit card. Just check and report anything funny right away. Okay, so before we do this, let's talk about, I don't have a slide for it, but let's talk about what are some of the dangers of using a credit card. Anybody want to chime in with that? What might be a bad thing about a credit card? Well, for one thing, if you don't pay the balance in full every month, you get charged interest, and sometimes unbelievably astronomical interest. I've seen with some of my clients, they have credit cards that are charging them 29%. That's almost 30% of what they bought. They're paying in addition in interest, which is really crazy.
We just had a comment about late fees as well and having too many credit cards.
Yes, late fees, not only late fees, but some credit cards companies charge a fee for you just to have the card. So you might have to pay $79 a year, $99 a year, $150 a year, whatever it may be, just for the privilege of using that credit card. Now, some cards, if you're playing the travel point game, it's worth it sometimes, but you have to be very savvy about how to do that. Otherwise, you're paying that $150 just to have a card, which is crazy when there are lots of cards that don't have those fees. But the biggest danger of credit cards is combined with the interest, they're easy. You can easily say, oh, I can buy that $300 sweater. I don't have the cash in the bank, but I've got this little piece of plastic in my wallet. And it doesn't feel like you're spending money until all of a sudden you have $10,000 of credit card debt at 25%. So they're a little bit too easy. So let's talk about the 4 rules of using credit cards. Number 1, they're not free money. Don't use them as free money. So let's just take one example. Let's say you have $10,000 of credit card debt, and your minimum payment on that $10,000 is $275 a month. And the average interest rate in the United States for credit cards is 20.92%. So let's just use that. If you only pay this monthly payment of $275 a month, it's going to take you 5 years to pay off that debt. Those boots you bought are going to be worn out by then. You know, the things that you bought with that credit card are probably going to be not used anymore, and you're still paying it off 5 years later. And not only that, but you're paying almost $6,000 in interest. So whatever you bought for $10,000, but you didn't buy it for $10,000. You bought it for $16,000, almost, because of the interest, if you're only paying the minimum payment. So you have to get in the mindset of only using them like a debit card, only buying things unless there's a big emergency, only buying things that you have money in the bank to pay off. All right, so that's rule number 1. Don't use them as free money. Number 2, always pay your balance in full every month. So there's a myth. People have the misconception that they're not going to build good credit unless they carry a balance on their credit card. Not true. You can charge, let's just say $100 to make it easy. You can charge $100, pay it off before the due date, by the due date, so that you don't get any interest charged on it, and you're building good credit. You're in fact building great credit if you do that consistently. And I'm also going to tell you another trick, because for people who like getting the travel points and other things, and they use their credit card for everything. They use their credit card for groceries. They use the credit card for entertainment. They use the credit card to pay as many bills as they can. And all of a sudden, at the end of the month, they have a $4,500 bill. And they're like, oh my gosh. Whereas if you just day by day paid those out of your bank account, it wouldn't feel like this big, huge payment that you have to make all at once. So a little trick you can do is with your credit card company, whether it's Chase or Capital One or whatever it is, you can get online, get your account hooked up online. You can pay that every day if you want. Let's say you buy groceries for $150. Well, the next day, get online and pay $150. Gone. So you still get your travel points, but you're not getting that big bill at the end of the month. You can pay it every week if you want. Or better yet, you can set it up at auto pay, and once a month it can just pull from your account and pay that bill. But do not pay interest. That's like, unless you absolutely have to. It's paying interest is like this weight on your shoulders. You're not buying your shirt for $75. You're buying it for $130 if you're paying interest. All right, rule number 3, put it on auto pay so you always pay on time. And this is probably the most important one. So we talked about credit reports and credit scores. And there are several things that go into increasing your credit score and keeping your credit score high and not having your credit score tank. The most important one by far is paying your bills on time. Anything that's going to show up on your credit report. So if you have bills that you're having trouble paying one month, pay at least the minimum. I hate to say that because we want to pay it in full, but if you can't, pay at least the minimum on anything that will show up on your credit report. Credit cards, auto loans, mortgage, any of those debt payments, they're going to show up on your credit report. And if you're having trouble paying it, call the company. Say, I'm having some trouble. Can I make a lower minimum payment for the next 3 months? Sometimes they'll say no, call again the next day, see if you get a nicer person. But more often than not, they want to work with you. So super important to never, ever pay a credit card or an auto loan or student loan or anything that's showing up on your credit report, even 1 day late. Okay, because this is the number one thing that's going to help you with your credit score. And also, somebody mentioned late fees before. Late fees on credit cards are like $35. And if you have three credit cards that you're late on, that adds up. And if you're doing it month after month, that adds up. So paying your bill on time is super important. Okay. Rule number
Deborah,
4.
we received a question real quick about that topic.
Sure.
Does always paying credit card bills on time and in full always guarantee good credit?
As long as you pay your other bills on time too, but that will go a long way towards increasing your credit score. So if you pay your credit cards on time, but you're not paying your auto loan on time, your credit score is going to go down. And also there are other things that will impact your credit score. We're going to talk about one of those other things, but paying on time, I think it's like 35% of your credit score. It's a big chunk of your credit score. The other factors are smaller percentages. So as long as you're paying anything that shows up on your credit report on time. Does that answer that question? Okay.
Yeah, thank you.
You're welcome. Okay, so paying your bills on time is number one. It's like 35%. Utilization rate is the second most important thing that impacts your credit score. What is utilization rate? So here's a little visual to help you explain it. Let's say you get a credit card, and this credit card has a $5,000 credit limit. That means you can borrow up to $5,000 before you get that, you're at your credit limit, you can't spend any more. But bankers do not want to see you use up this whole bucket of $5,000. Because if you do, they're going to say, oh, this person's in a little bit of financial trouble. They're right up to the top of their credit limit. So the general rule for good credit is to use no more than 30% of your credit limit. So 30% of 5,000 is 1,500. If you have a credit card with a $5,000 credit limit, don't spend more than $1,500. And again, you can get online and pay that thing down and then go spend up to $1,500 again if you want. Just don't spend over 30% of whatever your credit limit is. And I often get the question, is this just for one credit card? Or if I have 5 credit cards, do they just look at it all together? It will be a little bit less of an impact if you have 5 and on one of them you're up to the credit limit, but on the others you're nowhere near. That won't be as bad as if you just have one credit card and you're up to that $5,000 limit. But even that one will bring your score down a little bit. So you want to make sure whatever the credit limit is, that your utilization rate, the amount that you're spending, doesn't go over 30% of whatever that credit limit is. So those are really the 2 most important things for your credit score: Paying your bills on time is number one. Keeping your utilization rate to 30% or below of your credit limit on credit cards is number two. Now, usually an auto loan, you're just going to have set payments every month, the same amount every month, so you don't have to worry about it. Same thing with student loans. It's usually just with credit cards that we're worried about this utilization rate. And there are other things that will impact a credit report, like how many, what we call hard inquiries you get. So if you're about to apply for a mortgage, not a good time to go try to take out 5 new credit cards, because each time that company looks at your credit score will go down a little bit. It will eventually come back up, but you don't want to close a credit card and you don't want to open credit cards when a banker is looking at your credit report and looking at your credit score. So there's that. Another thing that will impact your credit is your credit history, how long you've had credit. Can't do anything about that. If you're young and you're just starting out, you can't have a credit history of 10 years. So that's not something that you can so much control. But really the two most important things are paying your bills on time and utilization rate. Okay, let's talk about what to do if you're over your head with credit card debt. It happens. It happens to a lot of people. It's easy to happen. It's one of the dangers of credit cards. So next time we're going to talk about budgeting. So of course, budgeting and slashing expenses are the first thing you want to do. You can freeze your cards. You can call up the credit card companies and say, please freeze my card, meaning you still pay down that bill every month, but you can't charge anything new on it. And you can sometimes call up the companies and work with them, or on your own, you can make a pay down plan. So we're going to talk about some of that. So let's talk about debt consolidation. And it's just what it sounds like, to consolidate, to put together. If you have 5, 6 credit card balances and you're over your head and you just can't keep up with the payments, you might want to put them all together into one loan with a lower interest rate. Sometimes you can get this kind of a loan if you have a credit union, sometimes at your bank. And the best thing to do is to get help from a nonprofit credit counseling agency first. And I can send Cynthia name and contact information for a couple of nonprofit credit counseling agencies. Beware of the for-profit ones. But if you go to a nonprofit credit counseling agency, they can help you with this. Some people who own their home and have equity in their home take out a HELOC, a home equity line of credit, home equity loan, and they use it to pay off their credit card bills. And I would say that is fine if you know why you got into credit card debt, you have a budget, and you have a plan for not getting into credit card debt again. But the danger with this is that you will take out the home equity loan. Now you'll owe that money that you've used the home equity loan to pay it off. Your interest rate is lower, but you're still paying this loan. And then your credit card balance creeps up again and again and again. And all of a sudden you have the home equity loan and the credit card balance. You're in over your head again. And guess what can happen now? Now the bank can take your house because you've tapped that home equity. Before, credit cards are what we call unsecured loans. They can't take your house. They can ruin your credit, but they cannot take your house. But with a home equity loan, if you don't pay it back, they can take your house. So you have to be really careful. It's not a bad plan. I've worked with clients before who have done this, and for them, it was a really good plan. But they had a plan in place. They had proven over several months that they can budget, that they can stick to the budget, that they're not using their credit cards to cover any of their expenses. So not a bad plan in that case, but just be very careful. Okay, debt settlement is another option. So debt consolidation is putting them all together into one lower interest loan. Debt settlement is when you negotiate with your creditors to lower your balance. And again, please be very wary of for-profit debt settlement companies. Not all, some of them are scammers. All of them want your money, and nonprofit is the way to go here. If you don't want to directly negotiate with the credit card companies, you want somebody to do it for you, go get some counseling from a nonprofit first. So with debt settlement, it's just basically somebody calling up the credit card companies. Often the credit card companies won't settle debt until you're several months of not making payments, which will affect your credit score. And debt settlement, by its very nature, will affect your credit score. Sometimes it's the best way to proceed, even so. Be aware that debt settlement can have tax consequences. So let's say you owe $20,000 and the credit card company has settled for $10,000. So now all you have to pay is $10,000. You've cut that debt in half. You may have to owe, and probably will owe, taxes on that $10,000 that they forgave. And also, of course, it will affect your credit score. All right. Let's talk about balance transfers. I'm sure you've all seen ads for 0% interest. You know, transfer your balances over to this 0% interest card. Also, not a bad thing to do if you are 100% sure that you have a plan in place and are able to pay it off within the time period that that 0% interest applies. Because for most of them, what happens is, let's say it's 12 months of 0%. On month 13, day 1, if you owe any of that balance, even a small amount, a high interest rate kicks in, and it's often retroactive all the way back to the beginning. So now you've paid a 3% fee to transfer it over, and you owe interest on the whole thing at a high rate. So just be careful. Read the fine print. Not a bad thing to do if you're able to pay it off within the time period. Some people like to maybe not transfer all of their debt if they're afraid they're not going to pay it off in the time period, but transfer a chunk of it, because 0 is certainly better than 29% or 20% or 17% or whatever that high interest rate is. All right. Let's talk about debt payoff strategies. Let me just check time. Okay, if I do this quickly, we have a little bit of time. So let's say you have 3 credit card bills, balances. One is for $1,000, one is a balance of $4,000, and one is a balance of $6,000. What's the best way to pay that thing down? Well, of course, budgeting first, trying to pull any extra money from your budget that you can, so you can throw some extra money at this debt. So you don't have to just pay that minimum balance and pay those high interest rates till they're years in the future all paid off. So the snowball method basically means you start with your smallest balance. The minimum payment, let's say that's $50 a month on a $1,000 balance. And let's say you pulled from your budget an extra $125 that you can throw at debt. So you, on these two, you pay the minimum balance. Let's say it's $150 for this one and $200 for this. So on this one, you're paying the minimum balance, which is $50 plus that extra $125. So you're paying $175 a month. Once you've paid this off, then that $175 doesn't go to buy new shoes or whatever. You apply this $175 to the next highest balance. So now you add the $175 to the $150. So now you're paying $325 a month, and you're paying this one off. When this one is paid off, you take this $325 and you add it to the $200 minimum that you're already paying on this one, and you pay this one off. Now, this method is very satisfying, because if you have one that has a relatively low balance, boy, does it feel good to just get rid of it. It's emotionally very satisfying. Another common way to do it is the same process, but we call it the avalanche. And that is, instead of taking the smallest balance one first, you take the highest interest rate one first. So let's just say that this one has 25% interest, this one has 22% interest, and this one has 20% interest. So we're going to attack this one first, the same way we did before. The minimum balance is 150. You have 125 extra to throw at it. So you're going to pay $275 a month until this one is paid off. Then you're going to take that 275, you're going to add it to the 50 that you're paying for this minimum, you're going to pay this one off, and then you're going to add what you were paying to the 200 till you pay this one off. Usually with the avalanche, you end up paying less money in the long run, sometimes just a little bit. But sometimes it's hard for people to do because it might take longer to pay off that first one. It's a little emotionally harder. So these are the two kind of main ways. There are other ways, but those are the two more common ways to attack debt. Okay, so let's end with a quick little game, and then we'll open it up for questions and answers. And the question here is to credit card or not to credit card. So your car breaks, you're on your way out of town for the weekend, and you find yourself with unexpected expenses, towing, fixing the car, renting the car if it's going to take more than an hour or two for the service station to fix yours. Is that a good use of credit card or not a good use of credit card? What do you think? What would you guys do? I would say this is a pretty good use of credit card. If you're using your credit card for you're in an emergency situation, hopefully you have an emergency fund in your bank that you can use to pay it down. But this would be a good reason to use your credit card. Okay, you just broke up with your significant other and you're feeling really down. So retail therapy at the mall will make you feel better. Good use of credit card or not? I see that some people are adding
a lot of knots.
A lot of knots. You got it. All right, you're at Best Buy to purchase a new large screen TV, and at checkout, they offer you a 10% discount if you sign up for their credit card. Yes or no?
A lot of no's again.
Good. Almost never a good deal to get a credit card at one of these stores. Yes, you save 10% on your first purchase, but they're usually not great credit cards. And if you get a credit card, do it intentionally. Get a credit card that gives you some long-term points or something like that. So that would be a no. All right, your new credit card offers 75,000 bonus points towards travel if you spend 5,000 in the first 2 months of having the card. Your landlord won't let you pay your rent with a credit card, and other expenses don't quite add up to $2,500 a month, so you decide to buy a new iPhone to meet the $5,000 requirement. Current phone works fine, but it'd be nice to have a higher quality camera and larger screen, so why not? Yes or no on this one? What are we seeing, Cynthia?
Looks like we're getting no's again.
Yeah, you're right. Don't use a credit card to get points if you're spending money you wouldn't spend otherwise. That just defeats the purpose. All right, but what if you have the same situation and instead of buying an iPhone, you make up the difference of that minimum that you have to spend to get those points with gift cards at the grocery store? Because you know you're going to be buying groceries in the next 4 months, and you can use those gift cards to pay the groceries. What do you think of that?
You've got it. That's smart.
Yeah, it's not, if you have the money to buy the gift cards, that's actually a good thing to do. Yeah, because then you're getting your 75,000 bonus points, and you might get a free trip to, I don't know, Costa Rica, wherever. All right, one more. You're at the airport and your flight was canceled. They can get you on another flight the next afternoon, but you're on the way to your cousin's wedding and you'll miss it if you wait until the next afternoon. You look up flights on your phone and see that there's another airline. And so you could change planes, but it's going to cost you money, or you can rent a car and drive all night and get there in time. Use a credit card for this or no?
We've got a yes, two yeses, and some do.
Yeah, I think that would probably, I wouldn't want to miss my cousin's wedding if I were close with my cousin. So I think that might be a good use of your credit card. Okay, that was a lot. So questions, and happy to field questions.
Sure. We've got one in the chat. So I had 2 credit cards, had great credit, and then took out a home loan. It dropped my credit score 7 or 10 points. Can we prevent this from happening?
Okay, so you had a great credit score, you took out a home loan, and the home loan dropped. So that credit score is likely going to bounce back up fairly soon if you pay everything on time. Again, anytime somebody does that hard pull, an inquiry, you're getting a loan, so that bank looked into your credit, that's going to ding your score. I wouldn't worry so much about 7 points. Did you say 7 points?
Yep, 7 to 10
I
points.
wouldn't, I think that's going to bounce back up. Just pay your bills on time and watch your utilization rate on your credit cards. I wouldn't worry too much about that.
If one owns their home and car, how much credit do you really need? Will one monthly paid off credit card be worth having?
You know, that is a very personal question in terms of everybody operates differently. Do you need more than one credit card? Absolutely not. Sometimes can more than one credit card be useful and beneficial if you're playing the points game and you're really careful about fees and about paying things on time and you're very conscious of how you use it? Sure. That can work. But you if you own your home and car and you have a good credit history, you don't even really need a credit card. If you're paying your mortgage on time, that's building credit. If you ever had a car loan and you've paid it off and you paid your car loan on time, then you don't really need even a credit card. But again, different people like to operate differently. Some people like to have the credit card for the better fraud protection. Some people like to have it for the points. Some people like to have it for the convenience.
Sure, so there's a follow-up to that one. What if you don't need credit points? Does one have to have a credit card at all if there's no mortgage or car payment?
You don't. But I think my question for you would be, do you have a credit history? Because if you don't have any credit history, that could get in your way if you ever wanted to do, it could get in the way of your getting insurance. It could get in the way of depending on what kind of job you want to get. You never know when let me give you an example. My daughter lives in New York City. She's a dancer. She cannot yet afford, she's only 20, she cannot yet afford to pay New York City rents. She's got a bunch of roommates, but still she can't afford to pay New York City rents on her own. So I'm a guarantor on her lease. They checked her credit and they checked my credit. And if my credit were bad, she would not have gotten that lease. If her credit were bad, she would not have gotten that lease. So you never know when you're going to need credit. So it's if you have no credit history at all, might be a good idea to get a credit card, use it once every few months for some small purchase, and then pay it off right away. And make sure that there's no fee attached to it. If you have a credit history and your credit history is good, then you probably don't need to.
And then we have one that says, do you recommend any credit card programs for new college grads?
So I'm a financial coach and not a financial planner or advisor, and therefore by law, I cannot recommend specific banks or companies or Credit cards. I would advise you just to Google credit cards for college grads or credit cards for college students and compare them. Now, the interest rate would be an important thing to look at, but you want to really work with your kid. If you're not the one in college, if it's your kid in college, you want to really work with your kid about never paying interest, paying that whole thing off in full before the bill comes due so you don't pay interest. So if your kid's disciplined, and that's actually going to happen, the interest rate itself isn't as important. You want to make sure that there are no fees. You want to make sure, you want to know what the credit limit is, and you want to make sure that your student understands that they're not to use more than 30% of whatever the credit limit is.
It looks like that's all the questions that we had in the chat.
Okay,
Um,
great.
so
If any additional questions come up, my email address is right here, Debra@moneysmartforlife.com. Feel free to email me, or you can send questions to Cynthia. And I promise I'll be a little quicker this time in sending responses back. I forgot last time and just sent them from the last one just a few days ago, but I promise I will be more quick this time to send those responses back. So yeah, thanks so much. This was fun. I hope it was informative.
definitely, we always appreciate you coming. I always feel like I learn so much when I get to sit in on these. And then just a reminder for our participants, if you're interested in learning more about budgeting, Debra will be back with us for the final financial session, which is on November 2nd. You can register on our website. And I know we dropped the link earlier in the chat. If you would benefit from a course, training program, or certification, please take a look at our job readiness grant. That is also featured on our website, and you can always reach out to me as well if you have any questions on that. And thank you everyone for joining tonight. And please take a few minutes to complete the survey that'll pop up at the end of the Zoom. And we'd love to know your thoughts about this webinar and any future topics you'd like. Thank you so much for joining us, and I hope you all have a great rest of your night.
Thanks, everybody. I'll see you in November.